Good morning, everybody, and welcome to this, our first webinar session of the day. And this morning, we're going to be focusing on inheritance tax efficient investment options. I'll just give you a very brief introduction. My name is Matthew Smith, Managing Director of Buckingham Chartered Financial Planners. And as the name suggests, we are an independent firm of chartered financial planners, probably one of about 500 chartered financial planning firms now operating in the UK. All of our advisory staff are fellows of the Personal Finance Society, which is their highest possible accolade. And I'm delighted to say we were recently voted one of the top 25 financial planning firms in the UK as well. Please don't be fooled by the name. Although we started life on Buckingham Gate, the road, which is where we take our name from, we recently moved to brand new offices on Northumberland Avenue, which is where you'll find us now, just off Trafalgar Square. So we really have three key areas of expertise. Now, the session this morning actually kind of combines two of those, really. We're going to be looking at estate planning and investment management sort of in one here. So we're looking at some of the investment solutions that can assist us with mitigating and reducing our inheritance tax liabilities. Now, we are recording the session today, so for those people who stick with us to the end, there'll be a very brief feedback form to complete at the end of the webinar. That will give us your email address and we can then send out the webinar recording. So you don't need to be taking any notes if you don't want to. There'll be a recording come out to you later today, and then you can rewatch the session at your leisure. Just a few words on COVID. We've really seen a massive increase in demand for all sorts of estate planning and investment management services. And we've now developed a fully paperless and contactless application and drafting process for all of the different areas of business that we do with clients. So although we are now offering clients a face-to-face meeting in the office, if that's your preference, we do also have the ability to continue doing meetings over Zoom as well. So it's really up to clients what their preference is at the moment. So let's just have a think about some of the reasons why we want to invest for inheritance tax planning reasons. Why use some of these investment solutions rather than the other inheritance tax options like lifetime gifting or putting money into trust, for example? Well, I think there's a lot of reasons why these investment options are attractive. I think primarily it's one of the very few inheritance tax planning tools that allows you to retain full access and control to the funds. So in most other cases, if you want to significantly reduce your inheritance tax liabilities, it's going to involve giving money away in one way, shape or form. And of course, that means that you don't have access to it anymore. So when you gift money, although in some cases you can remain in control of the fund, you normally can't be a beneficiary. So these investment options are one of the sole options really where you are able to retain both ownership and control of the funds. The funds remain in your name, so it's your money. And normally after a 2-year waiting period, these investments deliver their inheritance tax advantage. Although, as we'll see in just a moment, there are a couple of solutions that deliver an immediate and upfront inheritance tax saving. Now, with some of these solutions, the inheritance tax reduction is also combined with some other very attractive tax saving opportunities. So we'll break those all down as we move through the options in just a moment. And as we'll see, although some of these solutions are often presented as very high risk investments, very often the tax relief that's available significantly reduces the capital that's at risk. Now, there are all sorts of different investments that fall into this inheritance tax efficient category, and they're not all high risk. That there are actually some very modest, very average investment portfolios that can be structured in such a way as to deliver an inheritance tax saving. And of course, the beauty with inheritance tax investing is that it can be just drip fed over time. They're very flexible. You can normally add money, take money away whenever you wish. So unlike some of the other solutions that do require perhaps a lot more commitment all in one go, when you're building up a portfolio of investments to try and reduce your inheritance tax liability, that's something that can be done gradually over time. So before we go ahead and look at all of the different options that exist in this inheritance tax efficient investing world, we're just going to explore some of the mistakes that people make when they look to start investing for inheritance tax mitigation purposes. And these are things that we see time and time again in our capacity as advisors. And I think the first mistake that people make is being scared of these investments. People sort of write them off without fully understanding all of the different options very often. And the first fear that people have is around losing access to the money. Many people perceive that if the investment is likely to reduce their inheritance tax liability, it follows that it must therefore be illiquid, and therefore you won't have access to the funds. Now, although there are a couple of inheritance tax investment options that are illiquid, the majority of them do provide either full or partial liquidity. So the risk of losing access is only true for a couple of the solutions that we'll talk about later, but in most cases, you do still retain full access to the funds. Now, as I've mentioned, many people perceive that these are high-risk investments, in inverted commas, and indeed some of them are, but some of them are actually very mundane when it comes to the investment portfolio. So as we'll see in just a moment, if an investment is structured to reduce an inheritance tax liability, it doesn't automatically follow that it has to be a high-risk investment. People naturally are scared of losing money, and of course that's a natural fear and something that you do need to be conscious of. Although, as we'll see a bit later, most of these options have all sorts of different tax reliefs and incentives attached to them. So very often the capital at risk is actually not that significant. So you don't need to be too concerned about losing money in many of these solutions. People are often worried about the tax rules changing in the future, and specifically about the tax rules changing retrospectively. Now, I think there's a common feeling out there that HMRC frequently goes back and changes rules retrospectively, which simply isn't true. In the vast majority of cases where HMRC has taken retrospective action, which doesn't happen that often actually, it's normally because people have sought to exploit a loophole of some description. So when people try and bend the rules or kind of manipulate a loophole, then yes, HMRC may well look to move retrospectively to close down some of those options. Everything we talk about today is very much in the sort of vanilla tax planning category. And indeed, many of the investment options that we're going to explore today were in fact conceived by the government and the Treasury. And very often the tax reliefs and the tax incentives that are available are designed to encourage investment into UK businesses. So these are Treasury government schemes that are designed to encourage investment into UK firms. Now, understandably, people are often concerned about the cost of these investments, and there's no getting away from the fact that most inheritance tax investing solutions are going to be more expensive than your standard unit trust portfolio. And that's for very good reason. These tend to be more niche and more actively managed solutions. So although the fees in some cases are higher, you have to weigh that up against the potential tax reduction and of course the returns that the investments can generate as well. And the final thing is just around understanding. Of course, human nature is to be slightly cautious about something that we don't fully understand. And so we hope really in the session this morning that you gain a far greater understanding of these investment options, and therefore you feel far more confident about which of them may or may not be appropriate in your own circumstances. So the second set of mistakes that we see people make is around the investment themselves. So when they're actually making the investment, there's various mistakes that people make along the way. Now, the first of these is a lack of diversification. We all know the old adage, don't put all of the eggs in one basket. But what we tend to find is that in this sort of inheritance tax investing world, people often concentrate their whole portfolio with a single provider. Now, the challenge we have in this particular area where we look at these inheritance tax investments, there's about 100 different providers in the market, but the vast majority of them are very small, very niche players. So you do need to be careful that you don't just put all of the eggs into a single basket because it happens to be the best known name. We often find that people don't fully understand the tax treatment of the things that they're investing in. Now, most people are aware of the headlines, things like inheritance tax relief and sometimes income tax refunds. But there's often other tax reliefs that are available on some of these solutions that people are just not aware of, and therefore they don't claim them. So we'll explore all of the different tax reliefs in just a moment, but it is important that you have an understanding of all of the different tax saving options that come with each of these investments. Now, as I've just mentioned, there's about 100 providers in this particular space, and they range from really fairly significant businesses that manage circa £10 billion worth of assets that have hundreds or thousands of employees. So that's the kind of large end of the spectrum. But on the other end of the spectrum, you almost literally have brand new startup companies that are being run by a man and his dog out of a bedroom somewhere. And so that's the challenge I think that people have when they're selecting providers is, how do I know if this is a provider that can be trusted? Does this provider have a track record? That's often not easy to establish. So it is important that people do very thorough research in this area. Now, it's very important that the tax tail doesn't wag the investment dog, as it were. Now, of course, the tax reliefs on all of these options are very attractive, as we'll see in just a moment, but none of that makes up for a bad investment. Tax relief will only get you so far. So yes, the tax relief is attractive and it minimizes the risk of any of these investment solutions, but we still want to make sure that we have a sound investment that's likely to deliver a positive return in the future. Now, one of the most, I think, misunderstood or in fact, just not known about issues when it comes to some of these inheritance tax solutions is what we call loss relief. So although we have various upfront tax reliefs on many of these investment solutions, if the investment falls in value, it's often possible to claim a further income tax deduction, which we call loss relief. But many people are just not aware of this. So I'd imagine there's a lot of people that may have been eligible that simply haven't claimed over the years. And then finally, it's interesting here because my first point was that people often suffer from a lack of diversification. On the other end, we see people that actually have too many providers, that they're so keen on diversifying that they'll place £5,000 with 10 different providers. And of course, that's making your life a lot more complex from an administrative perspective. And it also makes life much harder for your executors, the people that are going to be in charge of managing your estate when you pass away. Now, of course, bearing in mind, we're thinking about inheritance tax mitigation here. So this is all about estate planning. I think it is important that we try and simplify things as far as possible to make life easier for our executors later on. Now, the final category of mistakes that people make is around the advice that they take in this particular area. So the first issue, of course, is simply taking the wrong advice. And there are all sorts of people that want to give you advice in this area. There's the journalists in the press, there's, Gary down the pub. You need to be very careful, I think, who you're taking advice from and make sure that you're taking it from someone who has, qualifications, experience and expertise to actually be commenting on these kinds of investments. I think most people are familiar with the saying, past performance is no guide to the future. And I think that actually is far more important when we're thinking about this kind of investment. When we think about things like enterprise investment schemes or AIM portfolios, they often come in tranches. So unlike most mainstream investment funds, which are kind of everlasting vehicles, if we think about an enterprise investment scheme, for example, and I'm going to explain much more about that in a moment, they tend to come in tranches. So a provider will launch tranche number one, it will raise a certain volume of investment from clients, and then it closes. And then it's a brand new tranche that will contain a new portfolio of companies. And you need to be a little bit careful that companies are not trading off the reputation of one lucky tranche. So, we've seen providers before that have got maybe 9 or 10 different tranches, and maybe they got lucky on tranche 6 and it did spectacularly well. And they'll often kind of overemphasize that in their marketing materials. So you do need to be very careful that the provider has a consistent track record of delivering performance. Now, I mentioned fees again. Of course, there's the cost of the investment. There's also the cost of the advice on the investment as well. But interestingly enough, as we'll explore later, taking advice on these solutions often works out as a cheaper option than not taking advice. Now that feels a bit wrong, it feels counterintuitive, but most providers will have a significant discount on their initial fees if you apply through an advised channel. So very often taking advice on these investments will actually cost you less than going direct to the provider. And we'll show you a couple of examples of that a little bit later on. Now, given that there are something like 100 regulated providers within the inheritance tax investing world, I see no reason at all why people get attracted to unregulated investments. These tend to be investments in illiquid assets. They tend to pay the introducers very, very substantial commissions. And of course, there's no regulatory protection. There's no compensation scheme if things go wrong. So given the vast selection that we have within the regulated landscape, I simply see no reason at all for people to look at non-regulated solutions. And then finally, I really would caution against following press recommendations, to be honest, in a lot of areas of financial planning, but this especially. Bearing in mind, most financial journalists don't actually carry any qualifications to give investment advice. And I would suggest that very, very few of the people that write about these kinds of investments actually have their own money invested. So do be very careful. That's not to say that the press is always wrong or that you should never look at it, but do be very cautious if following press recommendations in this particular area. So broadly speaking, there are 4 different methods that we can use to reduce an inheritance tax liability. Now, each of these categories has lots of different options that sit underneath it, but broadly, we've got these 4 different categories of things that we can do. So the first of which is to give assets away, making lifetime gifts. There are certain kinds of investments, of course, that deliver inheritance tax reliefs or mitigations. Any debts that you have on your estate are deducted before we calculate inheritance tax, and trusts have a major role to play as well. So if you are interested, we're going to explore trusts and lifetime gifting in much more detail at 2 o'clock this afternoon. We've got another webinar on inheritance tax planning and estate planning at 2 p.m. and we're going to look at trusts and lifetime gifting in much more detail. But the focus of this morning's session is on the various investment solutions that we have available. So let's move on now and explore what those options are, and importantly, where they sit on the investment risk spectrum. So we have here our investment risk spectrum. Now, different providers have a different naming and numbering system. I've used a scale here of 1 to 5. Some providers might use 1 to 7 or 1 to 10. The principle is exactly the same. You have a spectrum in which we're going to measure the risk or the volatility of an investment. Now, the first thing to mention here is that you will notice that the high risk category, risk 5, actually takes up far more of the spectrum than it should. And this, I think, is a bit of an anomaly, really, in terms of how we describe investments within the sort of investment world, really. And what you'll notice is that if we put together a totally standard, unit trust portfolio that was 90% equity, 10% bonds, tracking all of the major stock market indices in the world, the FTSE 100, the S&P 500. So really, it's a fairly broad, very well diversified portfolio. We would still probably put that in the high risk category, although I'm not sure it's actually particularly risky, probably more volatility is the issue we're concerned with there. Now, equally, if you made a single investment into a single company within a seed enterprise investment scheme, we're investing essentially into a single startup business, that would still be in that high risk category, although the 2 different solutions are worlds apart in terms of the actual risk to your capital. So that's why I've kind of elongated the high risk section here, just so we can see how things compare to each other. Now, the first item I put on the list here, this is in the sort of very low risk category, is actually a whole of life insurance policy. And although in the strictest sense it's not an investment, you can sort of use it a little bit like an investment for inheritance tax mitigation purposes. So a whole of life policy is essentially an insurance, a life insurance policy that, as the name suggests, lasts for your whole life. And as long as you keep paying the premiums, then your beneficiaries are guaranteed to receive a payment when you pass away. Now, we're not going to cover that in detail this morning because it's not technically an investment, but it can look and feel a bit like an investment because you pay a monthly premium and you get a lump sum at the end of it, effectively. And very often, when you look at the premiums you pay versus the money that you receive at the end, it's normally something like a 50% discount. So if you wanted to buy a £500,000 whole of life policy to pay £500,000 to your beneficiaries, you might expect to pay about 250,000 in premiums during the rest of your lifetime. So I put it on here for completeness, but it is a very low risk, in inverted commas, investment option to try and help with an inheritance tax liability. Now, moving up slightly, we have what's called the discounted gift trust or the gift and loan trust. Now, in these options, you can take a completely conventional, standard unit trust portfolio in FTSE 100, S&P 500 type businesses, and we just wrap it in a trust framework to deliver a certain inheritance tax saving. So as I mentioned earlier, these are the kinds of investments that will, they drive an inheritance tax reduction. They don't need to be high risk at all. These can be very conservative portfolios. I also think it's worth putting pensions on the list as well, because pensions by default are outside of your inheritance tax estate. So although a lot of people don't view pensions as an inheritance tax planning vehicle, and of course primarily it's an retirement income vehicle, but you can use these to reduce your inheritance tax liabilities as well. Now we move into the slightly higher risk category. First and foremost, we have portfolios of AIM shares. So these are shares listed on the AIM, the alternative investment market, which is the junior market of the London Stock Exchange. So although these will often be described as smaller companies in inverted commas, we're often still talking about businesses with multi-million-pound turnovers and sometimes thousands of staff. So we're definitely not talking about sort of 2-3 person startups. The AIM market tends to be slightly more developed businesses. We then have the Enterprise Investment Scheme, or EIS. So now we are talking about slightly newer companies, often still with multi-million-pound turnovers, maybe up to about 50 staff, but we're definitely talking smaller businesses. And then we have the Seed Enterprise Investment Scheme. And now we really are talking about really fresh, brand new startup businesses, probably with fewer than 10 employees. Now, we're going to explore each of these options in a lot more detail in just one second. But just to sort of categorize them, on the left-hand side, we have what I would describe here as conventional investments. So you're taking a completely standard, unit trust type portfolio, and you're just wrapping it up in a certain way to deliver an inheritance tax saving. On the right-hand side, we have what I would call inheritance tax investments. And these are investment solutions that really have been designed to take advantage of some sort of inheritance tax relief and other tax saving opportunities. So in this box, these will tend to be the slightly more volatile, the slightly riskier solutions. So we're going to look through each of these in turn now. So the traditional investments, first and foremost, as I say, these are otherwise, in inverted commas, normal investments. However, we structure them in such a way as to deliver an inheritance tax saving. And these generally are going to be available from all of your mainstream high street sort of financial providers: Prudential, Standard Life, AJ Bell, Nucleus. All the main names in financial planning will offer these kinds of solutions, generally speaking. So the first option here is what we call the gift and loan trust. Now, what the gift and loan trust is designed to do is to freeze the value of an asset. So let's say, for example, here we've got Jack, and he's got £300,000, and Jack's estate is precisely at the level of the tax-free limit for inheritance tax purposes. So if Jack gains £1 in growth on his £300,000 portfolio, then it's going to push him over into the inheritance tax sort of band. So he'll start paying 40% on any growth that the money generates. So what we can do is we put the 300,000 into a gift and loan trust. Now, any growth or income that this money generates is put into a sort of separate box. And that second box is automatically outside of Jack's estate from day one. So to be clear, the gift and loan trust doesn't reduce a current inheritance tax liability, but it does stop it getting any worse because of assets appreciating over time. So it keeps all of the growth and income outside of the estate. Now, Jack has the right to receive anything up to the full £300,000 back whenever he needs it. But what most people do with a gift and loan trust is they'll take a regular annual repayment, which is equivalent to 5% of the initial investment. So in this case, Jack then gets a £15,000 annual, and again, we call it an income. It's not strictly an income, it's actually a return of his original capital. So there's no tax to pay on that money, but Jack now has a £15,000 payment coming back to him. Now, when Jack passes away, anything that's left within the gift and loan trust can then pass on to his beneficiaries. In this case, we're assuming his children. So a gift and loan trust is really good for people who want to sort of freeze the value of their estate. So it doesn't make the current situation any better, but it does stop it getting any worse in the future. Now, the discounted gift trust is almost the opposite of a gift and loan trust. So with a discounted gift trust, again, we've got Jack here with his £300,000. The 300,000 goes into that kind of right-hand side. So Jack no longer has access to the £300,000. What he does receive is a regular income payment out of the trust. Now, again, the income is technically treated as a return of capital. So there's no tax to pay on that income stream. But the 300,000 is out of Jack's hands. So this is a really good solution for people that are capital rich and income poor. In effect, you're handing over a pot of capital, and in return, you're receiving a regular income stream. Now, what's really interesting about a discounted gift trust is that it's one of the very, very few investment solutions that delivers a day one inheritance tax saving. Most of the options we look at today require a 2-year waiting period before the IHT saving kicks in, whereas the discounted gift trust delivers a day one inheritance tax reduction. Now, the way that this works, I'm going to reset this example just to show how everything works. So we've got the 300,000 that goes into the trust. Now, at this point, the provider of the discounted gift trust will do an actuarial calculation to decide how long Jack is likely to live. And that's based on his age and his health and all these other factors. And they'll work out how many of those 5% income payments he's likely to get back, those £15,000 income payments, how many of those is he likely to receive? And the answer to that question then informs a discount. So in this example, this is a real life example, if we imagine Jack was a 65-year-old male and he's in reasonably good health, a bit of high blood pressure, a bit of cholesterol, but nothing too major, he would achieve in this example a 74.5% discount. So on day one, having made a £300,000 investment, the inheritance tax estate is reduced by nearly £225,000. So he gets nearly a £90,000 inheritance tax saving on day one. So this kicks in immediately. There's no waiting period on the discounted gift trust. So this is really, really good for people that are capital rich and income poor. They want to kind of trade off a capital sum in return for, again, in inverted commas, an income payment, but it does generate an immediate inheritance tax saving, which is what makes this such an attractive solution. Now, when Jack passes away, the same principle applies. Anything left within the trust would then be able to be paid to his beneficiaries. Now, the final option that we explore within this sort of conventional investment landscape is the pension fund. You know, personal pension, private pension, SIP, they all mean the same thing, whatever you want to call it. By default, pensions are outside of our inheritance tax estate. However, what we tend to find is that most people don't treat a pension as part of their sort of inheritance tax planning process, and therefore they often make a lot of mistakes in terms of how they handle it. So I'm going to go through a couple of case studies here to illustrate some of the problems that can be created if pensions are not sort of structured correctly from an estate planning point of view. So we've got Jack and Jill here, they're a married couple. They have 2 children, Bill and Ben, and we're also going to think about future generations as well. We're looking at the grandchildren and the great-grandchildren. So Jack has a pension fund worth £200,000. And in this first example, we're just going to assume that when he dies, he has said, I'd like all of my money to go to my wife. Now, that's what the vast majority of people would say in the first instance, and there's nothing wrong with that in principle. The principle behind it is sound, but it can cause all sorts of problems. So let's imagine Jack dies at the age of 70. So now Jill has the opportunity to take the whole pension fund as a tax-free lump sum. And presented with that opportunity, most people are going to say, well, yes, please, that sounds like a good idea. So Jill collects the whole 200,000 as a tax-free sum. Now, the only problem with that is that in doing so, the pension stops being a pension. So whereas in Jack's name, it was in that lovely protective pension bubble, it was outside of the inheritance tax estate, as we move the money into Jill's name, it's now just cash in her bank account. So when Jill passes away and the money goes to the children, we potentially lose 40% in inheritance tax. Now, if we imagine that Jill passed away at the age of 90, Bill and Ben at that stage, probably in their early 60s or something along those lines, and Bill and Ben were already independently wealthy. They had their own houses, their own investments. So Bill and Ben already had an inheritance tax issue, and now we've added another chunk of money on top. So when they pass away and we want to give the money to the grandchildren, we lose 40% inheritance tax again on effectively the same pot of money. And this is what we call multi-generation inheritance tax. So that's one of the problems with leaving money directly to a surviving spouse. Now, the same issues can occur in a different way. So we've got the same problem here, leaving money to the spouse, and we're going to explore some of the other problems that can occur. So Jack dies at the age of 70. The money goes to Jill. It's now just cash in Jill's bank account. Now, 5 years later, let's imagine that Jill gets remarried. She marries Bob. Now, when you marry, any will that you had previously executed is automatically null and void. So although Jill did have a will that left everything to Bill and Ben, that's gone now because she's just got married. However, in this case, there's good news because Jill and Bob, they're sensible people. So they each create a new will that leaves everything to each other on the first death, and then to their 4 children in equal shares on the second death, because Bob's got 2 children from a previous relationship as well. Now, the problem here occurs if Jill dies first in this new relationship, because now Bob is the person with the full £200,000 in his bank account. And at this stage, he's well within his rights to tear up the old will and make a new one, leaving everything just to his 2 children from the previous relationship. So he completely cuts Bill and Ben out of the equation. So those are some of the problems that can occur if we don't sort of handle our pension correctly as part of the estate planning process. So how do we prevent all of this from happening? So I'm going to rerun this case study one more time, Jack and Jill here. The only difference is this time, Jack sets up an asset preservation trust. And he says to his pension provider, please pay my death benefits into my asset preservation trust. So just to be clear, we're not putting the pension into the trust during Jack's lifetime. We're just changing the nomination form. It's a piece of paper that says where Jack would like the death benefits to go when he dies. So during Jack's lifetime, the pension is still his pension, still in his name. He can do whatever he likes with it. It's only the death benefit nomination that's changed. But now, when Jack dies, the 200,000 goes into the trust. And Jill is what we call the life interest beneficiary of that trust. And she's got 2 options at this point. She can either invest the money within the trust and pull off any income that it's producing. So let's imagine it's earning 5% a year, for example. So Jill now has a nice £10,000 annual income stream being paid out. And of course, fundamentally, that's what a pension is for. It's designed to provide an income in retirement. Or alternatively, if Jill would like access to the capital, she can take an interest-free lifetime loan from the trust for anything up to the full balance, so anything up to the full £200,000. And that sounds very formal and very scary, but in reality, that loan agreement is an A4 piece of paper that Jill would sign with her trustees, probably Bill and Ben, and it goes in a cupboard at home somewhere. So it's all fairly relaxed, but it's the loan that provides all of the protection. Because now, if Jill remarries Bob and then passes away first, it doesn't matter what her will says, before anything happens, the first £200,000 has to be repaid to the trust. And in addition, debts are deducted before we calculate inheritance tax. So now, when Jill passes away, the full £200,000 is repaid to the trust. And now we've got the full £200,000 available to use for Bill and Ben. And they've got exactly the same options. They can either invest the money and draw off an income, or they can take the capital in the form of an interest-free loan. And if they do that, when they die, the full £200,000 again would go back to the trust. And now we've got the full £200,000 trust fund available to use for the grandchildren. And then they pass away, the money can go back, and now the full £200,000 is available to the great-grandchildren as well. And all of this continues for up to 125 years, which is simply the maximum legal life of a trust in the UK. Don't ask me why it's 125 years, it's just one of those things. But suffice to say, we can probably pass money here through 3, maybe 4 future generations. And at the end of that period, end of the 125 years, the money just gets distributed to the surviving beneficiaries at that point in time. So probably Jack and Jill's great-great-grandchildren at that point. Now, that's one of the trust solutions that we have available. That's a bit of an insight. We're going to explore a lot of the other trust planning options in the seminar at 2 o'clock this afternoon. So if you would like to attend that session, if you just go back to your original email, the email that you used to sign up for this webinar, there's a second link in there to sign up for the 2 p.m. session. So you are welcome to attend that one as well if you wish, and we'll explore the use of trusts in much more detail in reducing our inheritance tax liabilities. But for now, we're going to move on and focus on some of the more specialist inheritance tax mitigation investments. So as I've mentioned, these are investments that you probably wouldn't describe as standard or conventional investments. These tend to be a little bit more niche. They tend to carry a higher investment risk, but as we've mentioned, this is offset to a degree, sometimes a very significant degree, by the tax relief available. We must be careful that the tax tail is not wagging the investment dog. And these generally are available from more niche providers. The best known player in this market is Octopus Investments, but as I've mentioned, there are over 100 different providers, and they really do vary from the sublime to the ridiculous. You need to be very, very choosy, very selective about which providers you're placing money with in this particular market. So we're going to look at AIM shares first and foremost. So in this particular example, and in fact all of the examples that follow, we're going to assume that Jack has got a £100,000 pot of cash that he'd like to invest in an inheritance tax efficient solution. So with AIM shares, Jack puts 100,000 into his AIM portfolio, and there's no upfront tax relief, but 2 years later, he gets a 40% inheritance tax relief. So in effect, we're looking here at the net cost of the investment to the beneficiaries. So if Jack had done nothing else, if Jack just kept the 100,000 of cash, the beneficiaries would have got 60,000, but now they're going to get 100,000. So the net cost of the investment is 60,000 effectively to the beneficiaries. So after the 2-year holding period, we get a 40% inheritance tax saving. Now we do need to be careful. There are something like 1,000 companies listed on the AIM market, but not all of them qualify for inheritance tax relief. So you do need to be careful with that one. There's no upfront income tax relief, and generally AIM shares are far more liquid than any of the other options which we'll explore in just a moment, the EIS or the SEIS options. As I say, there's a 2-year waiting period, and after that 2-year waiting period, you have the ability to gift the assets into trust, and it's then treated as an exempt gift. So there's no 7-year waiting period, there's no strings attached. So you can hold the shares for 2 years and potentially then gift them either to a beneficiary or to a trust without any other limitations. Now, just going back to that first bullet point here, the fact that not all AIM shares qualify, for that reason, we do think it's a very good idea to have a professional AIM manager looking after the portfolio. because over time, a company that was previously qualifying might stop qualifying for inheritance tax relief and vice versa. So it is important that you've got somebody looking after the portfolio for you to make sure that it retains its inheritance tax qualifying status. Now, the second option we have here is the enterprise investment scheme. So as I say, we are now thinking about investing in slightly smaller businesses, potentially still multi-million pound turnovers. They might have multiple offices, multiple staff, but smaller businesses generally than you'd find on the AIM market. So again, in this example, Jack puts £100,000 in. Now this time there's a 30% upfront income tax relief. So he puts 100,000 in, and HMRC then write him a check for 30,000, 30% income tax relief. The only caveat is that Jack must have paid enough income tax to be able to make that £30,000 reclaim. So you can't claim back more income tax than you've paid, but you can get 30% income tax refund on quite substantial sums now going into enterprise investment scheme. Now, 2 years later, there's a 40% inheritance tax relief. So the net cost of the £100,000 investment in this case is 30,000, because you've had 30,000 relief up front and then 40,000 of inheritance tax relief. In addition, with enterprise investment scheme, you can defer previous capital gains. So for example, if you've just sold a buy-to-let property and you've generated a big capital gains bill, if you reinvest that money into the enterprise investment scheme, you can defer paying the capital gains tax until you sell the enterprise investment scheme investment. So it doesn't make the gain disappear, but it's a good way of deferring the liability and sort of kicking the can down the road effectively. The capital gains that the investment itself makes are free of capital gains tax. And in addition, if the investment goes wrong, you can claim something called loss relief. And let's imagine, this is a very extreme example, but let's imagine Jack invested 100,000 and it falls to zero. So it's a total loss situation. Now, in this particular case, we invested 100,000 and HMRC then deduct the tax relief that you've already received. So you got a £30,000 income tax refund up front. So in effect, your actual loss is 70,000 in that example. Now the 70,000 gets deducted again from your income tax bill effectively. And if we assume Jack is a 40% taxpayer, that's a further £31,500 worth of tax relief. So as I mentioned earlier, although these are often perceived as very high risk investments, and the investments themselves are fairly adventurous, the tax reliefs available really limit the potential investment risk, because much of that is then sort of refunded in the form of tax relief. Now, the final option is the seed enterprise investment scheme. So here we really are talking about very new, probably sub £1 million turnover companies, probably with up to about 10 staff. So fairly small businesses here. Now we put 100,000 in. Now this time we get a 50% upfront income tax refund, again, so long as Jack has paid sufficient tax to reclaim. 2 years later, we get 40% inheritance tax refund. So the net cost of the investment in this particular case is £10,000. So already you'll see, the tax relief is vastly reducing the money that's actually at risk. Now, in addition, with a seed enterprise investment scheme, you can actually get capital gains tax exemption on existing gains. So using that same example, if you've just sold a buy-to-let property with a big capital gains bill, if you reinvest the money into the seed enterprise investment scheme, you actually don't pay the capital gain at all. It just disappears. You get capital gains tax-free gains on the actual investment itself, and we still have loss relief as well. So again, if we invest 100,000 and it falls down to nothing, falls to zero, HMRC deduct the tax relief you've already had. This time it was 50%. So you've actually lost 50,000. And again, you get a 40%, if we assume Jack's a 40% taxpayer, a 40% refund on that loss of a further £20,000. Now, this is going to be a slightly strange thing to get your head around, but I'm just going to paint a picture here of that person that's just sold a buy-to-let property and just has suffered a 28% capital gains tax bill on the buy-to-let investment. So let's imagine the gain was 100,000, just so we've got a nice round number to work with. So you would have paid 28,000 in capital gains tax. If you put that 100,000 into a seed enterprise investment scheme, the capital gains tax gets written off, so you don't pay the 28,000. You potentially get a £50,000 income tax refund, and you get 40% inheritance tax relief. So that's 40% plus 50% plus 28%. Now, by my calculation, you've just received 118% tax relief on your investment. So the tax relief is actually greater than the investment sum that was invested in the first place. So that's especially effective if you've got existing capital gains that you can roll over into this kind of investment. Now, please don't get me wrong. As I've said many times, the tax tail should not wag the investment dog. You need to make sure this is appropriate for your circumstances. You need to be comfortable with the risk that's being taken on. But in many cases, you find that these investments, you might be risking as little as 10p in the pound, sometimes even less than that. So the tax reliefs do minimize the risk to quite a significant extent. Now, just before we close, I'm going to look to bring all of this together in a case study. So how can we use different solutions to achieve the overall outcome that the clients are looking for? So in this example, we're going to go back to Jack and Jill, and they're a married couple, they're in retirement, they're comfortable, they've got final salary pensions that keep up with all of their day-to-day living expenses, but they would quite like an extra £15,000 a year of income to spend on nice holidays and cruises and things. As I've mentioned, they've got final salary, state pensions, which cover day-to-day needs. And just for simplicity, as we go through the case study, there's no growth factored in on any of these investments. So all of the figures just remain static, just so we can follow everything through. So we're looking here at the kind of tax impact of these solutions rather than the investment growth that they might generate. So first and foremost, we've got what I would describe as the typical scenario. So we've got Jack and Jill here. They've got 3 properties. They've got a £1 million family home. They've got 2 buy-to-lets worth 300,000 and 100,000 respectively. Jack has a pension pot worth 200,000. He's also got an ISA worth 200,000, 400,000 of cash in the bank. Jill has 200,000 in an ISA and 300,000 of cash in the bank. Now, the mathematicians among you would have worked out that the total estate here is worth £2.7 million. Now, the reason for that figure is actually more to do with the case study that we'll look at in this afternoon's webinar. The reason I've used the same figures here is just so people, if they watch both sessions, you can sort of see how the different solutions compare to each other. So this afternoon, we're going to be focusing much more on lifetime gifting and the use of trusts to protect family assets. But if you watch both, you can sort of see how they compare with each other. So in this first case study, I'm going to assume that Jack and Jill don't change anything. They leave everything exactly as it is. And then sadly, Jack passes away. They've got a very simple will in place, which leaves everything to the survivor. And let's imagine that Jack was 70 when he died. So all the money comes across to Jill. Now at this point, as in the previous example with the pension, Jill collects the tax-free lump sum out of the pension. So I'm just going to tidy everything up here a little bit. So Jill, now 400,000 in the ISA and 900,000 of cash in the bank. Because again, the pension has stopped being a pension now, it's just money in Jill's bank account. So now, when Jill passes away, we're passing down £2.7 million worth of estate to the children, and that will be subject to an £820,000 inheritance tax bill. So Bill and Ben receive roughly 1.9 million. Now, once again, let's imagine Jill died at the age of 90. So Bill and Ben were in their early 60s. They were already independently wealthy. They had their own inheritance tax problems already. And now we've added 1.9 million pounds on top. So when they die and give the money to their children, we lose another 750,000 in inheritance tax. So the grandchildren get roughly 1.1 million. And then if we take that one generation further, we lose 450,000. So the great-grandchildren are left with just 675,000 roughly over 3 generations. So we've lost over £2 million in IHT across the 3 generations. So let's have a look at how it could have been. Clearly that's not an ideal outcome. So we're now going to start to build in some of the planning options that we've explored in the session this morning. So we've got the same setup. I've wiped the slate clean. We've got Jack and Jill here with their £2 million estate, £2.7 million. So we're going to first and foremost look at Jack's pension fund. And exactly as in the case study earlier, Jack's going to set up an asset preservation trust and direct his pension provider just to pay the death benefits into the trust. So it's only when Jack dies that that kicks in. Now, please now keep an eye on Jack's money within his ISA, the little red arrow logo next to Jack. That money we're going to invest into a portfolio of AIM shares. So I've used a lemonade stand here. I'm exaggerating. As I've said, AIM companies are often multi-million pound turnovers, but smaller companies than the FTSE 100 behemoths that we're used to. So we put the ISA into the AIM share portfolio. And that is something you can do. If you have existing money within an ISA, you can use that money to go into an AIM ISA. So you're still protected from income and capital gains tax in the future. The next thing we're going to do is set up a discounted gift trust. And if you keep an eye on Jack's piggy bank, the cash, we're going to put 300,000 of that money into the discounted gift trust. So Jack is now left with 100,000 of cash in the bank. And the discounted gift trust, if you remember, is where you give away the capital. In return, you receive an income stream, which happens to be £15,000 a year, which of course is exactly what they wanted to pay for the holidays and the cruises. Finally, we're going to make an enterprise investment scheme investment. If you look at Jill's piggy bank, we're going to put 200,000 of Jill's cash into the EIS, which leaves her with £100,000 of cash in the bank as well. So now, when Jack passes away at the age of 70, the pension fund can go into the asset preservation trust, and the money that he's put into the AIM portfolio passes as an inheritance tax-free asset, as does the money in the trust. So now, 20 years later, at the age of 90, Jill passes away, and she's kept all of these holdings. So she's still got all of these different investments that are now in her name. So let's just have a look at all of the different tax savings that we've generated as part of that process. So we saved £80,000 in IHT by moving the pension death benefit into the asset preservation trust. We've made an £80,000 inheritance tax saving with the AIM ISA in Jack's name. We achieved a discount on the discounted gift trust, which saved £90,000 of inheritance tax on day one. And then we get an £80,000 inheritance tax saving from the EIS investment. And in addition, there was a £60,000 income tax refund as well. So in total, we've reduced the inheritance tax liability by £330,000 nearly, and we've got a £60,000 income tax refund. So we're nearly £400,000 better off than we were when we started. So just to summarise what's happened here. Having made all of those investments, Jack and Jill have still got access to a sensible amount of capital. They've each got 100,000 of cash in the bank. Jack has got his £200,000 pension, which is accessible if he needs it. And we left 200,000 in Jill's conventional ISA, which is also available. Plus, the AIM ISA in Jack's name is still accessible. They can get to that money if they need it. They received the £15,000 of extra income from the discounted gift trust, so they can take the holidays that they were looking for. And we still have a sensible, diverse spread of investments across all sorts of different tax wrappers and asset classes. And as I've mentioned, finally, we saved nearly £400,000 in tax as a result of those solutions. And the case study we've just looked at is very loosely based on a real client scenario. Of course, we've changed some of the details to protect privacy, but that's a very, very close representation of a real life case that we've worked through with a couple of clients. So I'm going to go into a brief Q&A session now. You might notice if you look at your Zoom toolbar, just towards the bottom of the screen, there's a little Q&A button. If you just click the button, you should get a little text box. You can type a question in and that will pop up on screen here. Some questions have popped up already. Apologies if I don't get to your question. I've got hundreds of people on the session this morning, so I probably won't be able to get to everybody, but I'll answer as many of these as I can, especially where they're relevant to the wider audience. Vashant has asked, can I transfer my ISA money into a discounted gift trust to save IHT? The answer is yes, you can. However, it would have to come out of the ISA to do so. So you can't kind of preserve the ISA wrapper. In effect, you'd have to cash in the ISA and then move the resulting money into the discounted gift trust. With that said, you can transfer the ISA into an AIM ISA. That would preserve the ISA wrapper and of course would also then give you the inheritance tax reduction after a 2-year waiting period. Vasant has also asked, can I transfer a crystallised pension fund into the asset preservation trust? Yes, you can, as long as you've got a drawdown plan. So even if it's a crystallised pension that's now in drawdown, you can still make a death benefit nomination into the asset preservation trust. So don't worry whether you've got a crystallised or an uncrystallised fund, or whether you're in a pension or a drawdown fund. All of those have the ability to be directed into an asset preservation trust. A lot of people are asking about the costs of our service. How do you work with clients? So I've got a few slides to cover those points in just a moment. That's a very, very common question. So I'll cover that in just 1 second for you. John has mentioned, in selling a buy-to-let, how long before we need to transfer into an EIS? The answer, John, depends if we're thinking about EIS or SEIS. With an EIS, you can defer the gain. With an SEIS, you can actually cancel out the gain effectively. And normally there's a window of 3 tax years that you've got to play with when it comes to managing a historic capital gain. So there is a reasonable time period that you can use before that option expires. Let's have a look. Yeah, Bob again is asking cost of specific advice. How much does it cost to set up these solutions? So we're going to come on to that in just one moment. Robert has asked, where might equity release arrangements fit into your scenario? The answer there, Rob, is that you can't really do equity release to fund these solutions, unfortunately. That's specifically sort of prohibited by HMRC. So you can do equity release to fund making gifts to beneficiaries, but you can't generally do equity release to fund these inheritance tax efficient investing solutions. So that's an option that doesn't exist, unfortunately. Let's do 1 or 2 more. Let's have a look. Yeah, this is from an anonymous attendee. After transferring assets into the asset preservation trust, can the asset be left to more than one person, e.g. split between 4 grandchildren? Yes, in fact, that's almost the default option. When you create a trust, you normally detail different classes of beneficiary. So you might say that the beneficiaries are all of my children and all of my grandchildren, for example. So you don't have to tie yourself down to one specific beneficiary. You can leave a range of different beneficiaries within the trust. And that's another reason we really like that as a solution, because it gives us far more flexibility later on to decide how to distribute the funds. I'll do one more question, which is just a follow-up question. Keith has just asked, what is equity release? Well, Keith, equity release is where you take what's known as a lifetime mortgage on your property, normally in retirement. So that releases a lump sum of capital. And then normally the mortgage is not repaid until you die out of the proceeds of selling the property. So equity release, it can be appropriate in certain circumstances, but it can be fairly expensive. And you often find that the interest charges eat away quite a substantial portion of the overall property value. So we tend to avoid it where we can, but in some cases it is a viable option for clients in certain circumstances. So just before we close, yeah, a lot of people are asking about the service and how our charging structure works. So of course, we sit here today in a webinar setting, and of course, we've given a generic presentation, which we hope you found useful and beneficial. If you would like to talk about your own circumstances in detail and how we might be able to help you individually, the first meeting in our process we call the discovery meeting. And that meeting is all about you, your circumstances, your situation, and what you're hoping to achieve out of the financial planning process. So during that meeting, we'll be able to analyse your current situation, provide a sort of headline of some of the options and solutions that might be appropriate for you. Now, ahead of that meeting, we will send you a brief pre-meeting questionnaire, which we call the discovery document, and we ask you to complete and return that to us ahead of the meeting. And that really serves a dual purpose. On the one hand, it allows us to do some preparation work before the meeting, and it also allows us to pair you with the most appropriate advisor in the practice based on your situation and the advisor's skills and expertise. We then move through a second meeting, which we call the financial planning meeting. And the financial planning meeting involves what we call a lifetime cash flow analysis. So we take all of your incomes, expenditures, your assets, your liabilities, and project those out until you're maybe 90 or 100 years old. And using that kind of analysis, we can often answer some of the big financial questions that we have in life. How much is enough? How much do I need to retire comfortably? Could I retire early? Can I afford to gift money to my daughter to buy a property? Those are the kinds of questions that we can answer as we go through that cash flow analysis process. We then go away and put together a personalized recommendation report for you. And that's always a completely holistic view of a client's circumstances. So on the basis that you're sitting here in an inheritance tax planning webinar, chances are it's going to involve some sort of estate planning solutions, but we always make any other financial planning recommendations within that file that might be appropriate as well. And we then have the third meeting in the process we call the implementation meeting. And that's where we'll present those recommendations to you, go through any questions you might have, and of course we can then implement the recommendations that you'd like to proceed with. So in terms of the costs, the discovery meeting we offer for a fixed fee of £197. That's including VAT. There's no commitment or obligation beyond that point if you don't want there to be. And at the end of that meeting, you have the opportunity to engage us then to go through the rest of the process that you see on screen. So the second meeting, the production of that written recommendation report, and then the third meeting to present the recommendations to you. So for that second part of the process, we charge a fixed fee of £950. Once again, that's including VAT, and there's no commitment or obligation, again, beyond that point if you don't want there to be. Now, at this stage, a lot of people are probably thinking, well, okay, that all sounds wonderful, but how much does it cost to implement the solutions? Now, of course, the answer to that is it depends. Everyone's circumstances will be different. Everybody will have a different set of recommendations. But I will just give you a couple of examples from the case studies that we've looked at today. So remember, we had Jack with his £200,000 pension fund. We saved £80,000 in IHT. The legal fee for an asset preservation trust is around £1,600 or something like that. So a pretty good return on investment, I think. And then we went through that larger inheritance tax case study. So we invested a total of £700,000. We created nearly £250,000 worth of IHT savings with a £60,000 income tax refund. The fees for a case like that, I'd imagine, would be about £14,000 or something like that. And as I've mentioned before, as counterintuitive as it might seem, taking advice is often cheaper than not taking advice when it comes to these kinds of investment solutions. So this is a real life example with one of the main inheritance tax investment providers. If you apply to them directly on the right-hand side here, if you make a £100,000 investment, the provider will charge you an initial fee of 5.5%. So you pay £5,500 in costs. If you apply through an advisor, a typical advisor would probably charge a 2% implementation fee for this kind of work. And then the provider discounts their fee to 2% as well. So you pay £4,000 to go through an advised channel. So the advice is £1,500 cheaper, of course, less hassle, gives you much more protection, and I think a far better chance of things working out as you expect, far less chance of things going wrong. Now, as I've mentioned, when I close the session down in the next 30 seconds or so, a feedback form should automatically pop up in your web browser. It will take you no more than 30 seconds to complete, And on that feedback form, you have the opportunity to request your own discovery meeting. So if you would like a discovery meeting with somebody from the practice, please just tick yes in the box there, and somebody will be in touch very shortly to make the arrangements with you. As I've mentioned, we can do those meetings either on Zoom or in the office in central London, depending on your preference. That's entirely up to you. In addition, when you complete that feedback form, you will also then receive later on a copy of the webinar recordings, so you can then watch the session again at your leisure if you would like. Now, the feedback form should automatically pop up. For whatever reason, if that doesn't happen, you can just go to the web address that we have on screen here. So it's buckinghamgate.co.uk/feedback, and you will arrive in exactly the same place. But as I've mentioned, it should in theory pop up automatically, but if not, go to the web address and you'll arrive at the same place in any case. So thank you very much for being with us this morning, very much appreciated. The form will pop up in just a moment. If you would like a discovery meeting, we'd be delighted to see you and talk about your own circumstances. And we hope to see many of you back for the 2 o'clock estate planning webinar this afternoon as well. Thank you very much for being with us this morning.